What's up, guys? This is Manoj Guptani. I welcome you all on behalf of the Edupedia world. Guys, by now we have already covered two most important chapters of CA Final, SFM examination. So, one is basics about strategic financial management and bond valuation. We've already covered the theoretical as well as the practical concepts relating to both the chapters, and also those questions which have already been asked in CA Final examination in their past trending examination patterns and examinations. So today we'll mark the beginning of one of the most interesting and important chapters of CA Final SFM, that is mutual funds. But before marking the beginning of this chapter, I would like to reiterate you your promise to me of making regular and recurring revisions time and again. I am again and again forcing you to go on this particular aspect because I don't want you to fail at any cost. Certainly, CA Final is one of the most vast examination one can have, and in order to crack that examination, you'll have to have those strategic management techniques with you, with which you can clear off with flying colors. And one of those is retention and revision. So do emphasize on those aspects time and again so as to ensure that you don't flunk in any of your attempted CA Final. So we'll mark the beginning of this chapter because it's a wonderful day and we just need to have the conceptual clarity regarding mutual funds. And there we go. What is mutual fund? The first thing that comes into your mind, what is mutual fund? So a mutual fund is an organization that pools the savings of a number of investors called unit holders who share a common goal. Just like people who invest in shares are called shareholders of the company, the people who invest in mutual fund are basically known as unit holders. The money collected is invested by the professional fund managers in different type of securities depending upon the objectives of the scheme. So the old aged persons are going to invest in a kind of scheme that provides them a fixed amount at the end of each year, maybe a fixed dividend, maybe a fixed kind of capital gain. So they'll prefer that kind of investments. But in case of younger generation, since they are having much time and their lifespan is quite large as compared to the old age people, they are deemed to be more aggressive and certainly less risk averse in that sense. So money collected will be initially invested by those professional fund managers in different type of securities depending upon the objectives of the scheme and the objectives each and every individual. The return or the loss on investment is shared by the unit holders in proportion to the number of units owned by them. So guys, basically a mutual fund is an ideal kind of investment vehicle in today's complex financial scenario. Price changes in financial assets are driven by so many events, including all those events which are taking place in other countries as well. An ordinary investor is unlikely to have any kind of knowledge, skill, or time to understand the implications which are being involved in those kind of events and to act speedily. It is also difficult for them to keep track on various investments. So, investment in such a case in those mutual funds take care of all these problems. A mutual fund offers you an opportunity to invest in a diversified and professionally managed portfolio at a relatively less cost. When one invests in mutual fund, there is no guarantee that he will have a positive income only. There might be a chance that he may end up even with a loss because sometimes there are some volatile fluctuations in the prices of investments. Even professional may not be able to protect a unit holder's money, but it is always recommended to invest in these kind of securities because ideal money is not going to help you in any way. The funds which are remaining ideal in your bank account certainly don't fit the bill and certainly don't fit out any kind of purpose. So it's better to invest your money which is remaining idle rather than keeping it idle in your bank accounts. So that is why these kind of schemes, mutual fund schemes, investment in stocks, investment in real estate, investment in other market instruments is available. I would actually highly recommend each one of our viewers to start investing in mutual funds because it can be made even with a nominal SIP of rupees 500 each month. That's great news, guys. Even if you are having just rupees 500 in your pocket, you can start investing in mutual funds. And so, what are the routes and what are those companies which are going to provide you that kind of services? We discussed about those. That are the major mutual fund companies in India. HDFC Mutual Fund, ICICI Prudential Mutual Fund, Reliance Mutual Fund, Axis Mutual Fund, UTI Mutual Fund, Birla Sun Life Mutual Fund, Tata's Mutual Fund, Franklin Templeton Investments, and you have IDFC Mutual Fund, you have SBI's Mutual Fund, you have BlackRock's Mutual Fund, Kotak Mahindra is also providing you the mutual fund services, JP Morgan Asset Management Company is providing you, Motilal Oswal is also providing you. There are n number of mutual fund companies which are prevailing and available in the market. Just need to go with the ones which are providing you a better chances in terms of less brokerage and higher possibilities of their profit margins. So you just need to access that kind of historical information as to what have been their kind of returns, how much they have earned by now. So that kind of knowledge is going to help you out while choosing out which is the best one amongst the lot and which mutual fund company is going to act as per your objectives. So what are those advantages? We have been already listening about mutual funds here and there. And so what are those advantages which are being involved in investments in mutual funds? So the major are the four: diversification, liquidity, professional management, and ease of comparison. So guys, let's talk about professional management first. Mutual funds provides the services of experienced and skilled professionals backed by a dedicated investment research team that analyzes the performance and prospects of companies and select those suitable investments to achieve the objectives of the scheme. That is the first and foremost advantage of mutual fund. Let's move on to diversification now. Mutual funds basically invest in a number of companies across broad cross-section of industries and sectors. This helps in diversification, which indeed helps us in reducing the risk with far less money than one can do on their own. Let's move on to convenience, convenience administration now. Investing in a mutual fund reduces the paperwork and helps in avoiding many problems which are concerned with bad deliveries, delayed payments, and follow-up with brokers and companies. Mutual fund indeed save time and makes investing easy and convenient. Liquidity is another aspect which is being termed as an advantage for mutual funds. In an open-end schemes, the investors get back the money promptly at NAV related prices. NAV is basically net asset value prices from the mutual fund. In closed-end schemes, the units can be sold on a stock exchange at a prevailing market price, or the investor can avail the facility of direct repurchase at NAV related prices by the mutual fund. That's how liquidity works out as an advantage for mutual funds. Indeed, apart from that, there are n number of advantages for mutual fund, and these are low cost, transparency, flexibility, affordability, choice of schemes, well regulated. So if we'll talk about low cost, mutual funds are relatively less expensive to invest compared to directly investing in the capital market, because the benefits of the scale in brokerage, custodial, and other services translate into lower cost for investors. That is the best advantage in terms of mutual funds. Apart from that, there is some transparency. You get regular information on the value of your investment in addition to disclosure on the specific investments made by your scheme, the proportion invested in each class of assets, and the fund manager's investment strategy and its outlook. You also get to know about the flexibility through features such as regular investment plans, regular withdrawal plans, and dividend reinvestment plans. You can systematically invest or withdraw funds according to your needs and convenience. Apart from that, you have affordability. Investors individually may lack sufficient funds to invest in high-grade stocks. There might be chances that a person is not having so much money to invest directly into stocks. So an SIP, which I have already told you about the same thing, it helps in a mutual fund because of its large corpus. It allows even the small investor to take the benefit of investment strategy. Along with that, you also get some choice of schemes. Mutual fund offers a family of choices of schemes to suit you for your varying needs over a lifetime. You can be an aggressive investor, you can be a risk aversive investor as well. So, as well as the well regulation is concerned, mutual funds are well regulated. They have been overseen by the board and investors and being regulated by Securities Exchange Board of India. So, guys, that was about so many advantages of investment in mutual funds. But as it's always said, with each and every kind of advantage comes disadvantage on its own. So let's discuss about those disadvantages of mutual funds. This question has already been asked in CA final examination November 2008. So there are main four broad disadvantages for mutual funds. One is higher cost. Second, outperformance by the index. Third, management fees. And the fourth one is unpredictable results. So guys, even mutual funds face the risk of losing the money which is invested owing to market risk, poor performance of fund manager, poor policies of the fund house. Investors actually cannot choose the securities with which they want to invest in. Investors face the risk of fund manager not performing well. Diversified mutual fund portfolios may provide less returns than the investor expects, as investor may earn more by selecting few good stocks by investment. So you'll have to go by these kind of bonds. And it is unfortunate that an investor can rely only on past performance to select a good mutual fund, and it may not guarantee that good returns for future. Many mutual funds may provide positive returns but may provide returns less than the benchmark, that is by index. If fund manager's pay is linked to the performance of the fund, he may be tempted to perform only on short term, and in such a case he is surely going to neglect the long term performance of a fund. The management fees which is being charged by the fund reduces the returns which is available for the investors. Investors in mutual fund have to rely on the fund managers for receiving any kind of earning made by the fund, and hence they are not at all automatic. So guys, those were some of the few disadvantages of mutual fund. Though each and every kind of aspect which is being involved in the world has its own advantages and disadvantages, but don't lose your heart. Definitely go for investment somehow in mutual fund or some exchange traded fund. I'll be covering that exchange traded funds like in my forthcoming presentations as well. So by the time, don't lose any kind of hope. Definitely do invest in certain securities, stock market or mutual fund. That is going to help you for regulating your money, not making it remaining idle. So now let's move on to another topic, that is about mutual fund schemes. What are the three main broad mutual fund schemes? This question has already been asked in CA final examination November 10. So the basic classification on the basic structure is involved on three parts: open-ended schemes, closed-ended schemes and interval fund schemes. So what are open-ended, what are closed-ended, what are interval funds? We'll discuss about these one after the other. So let's begin with open-ended schemes first. Open-ended scheme is a scheme that allows the one that is available for subscription all through the year. These schemes do not have a fixed maturity. That's the best part about open-ended scheme. Closed-ended scheme is a scheme that has a stipulated maturity period. The fund is open for subscription only for a limited period. The last one comes into the picture, interval fund scheme, a scheme that combines the feature of open-ended as well as closed-ended schemes, making the fund open for sale or redemption during predetermined intervals, is known as interval fund scheme. So that was the broad classification of schemes. Now let's dig down somehow on each and every scheme. Let's discuss about the classification of open-ended schemes first. How do open-ended schemes are being classified? Open-ended schemes are being classified into major four categories: liquid, equity, balanced and debt. In liquid schemes, mostly amount is being invested in money market instruments, the ones from which the money can be extracted at any point of time. In equity, mostly the investment is made into stocks of different companies. That can be large cap companies, that can be mid cap companies, that can be small cap companies. In debt, all the investment or major investments is being made on debt securities and instruments like bonds, debentures of any kind of company. Whereas in case of balanced, the amount is invested in debt, liquid, and equity simultaneously. And that is why it is called as balanced kind of structure for open-ended schemes. That is how it does work. So for old age people, it is better to invest in any kind of open-ended scheme that is relating to liquidity and debt. For aggressive kind of investor like young people, it is always recommended to go for equity and liquid. And a kind of person who is or has already settled in kind of his family, it is always recommended to go for a balanced kind of portfolio in terms of open-ended schemes. So there they can have the benefits of debt, liquid and equity portion as well simultaneously. So now let's move on to the further classification of open-ended schemes relating to debt. In debt, we can have these 5 major parameters. One can have gift, one can invest in those schemes which are further investing into flexible kind of bonds. Third, one can invest in those schemes that are investing in long-term bonds for higher maturities, maybe like for 10 years, 20 years, 30 years down the line. We can plan a young investor who is at the age of 20 or let's say 25. He can plan accordingly for long-term bonds so that by the time of his retirement, he'll be able to cash in a lot of opportunities in terms of open-ended schemes by the time of long-term bonds. Or the fourth one, that is short-term bonds. You can easily invest on those kind of securities as well, which further invest into short-term bonds relating to period of 1 year, 2 year, 3 year, 4 year accordingly. Or you may invest in those schemes which are ultra short-term bonds. So those kind of open-ended schemes that invest in ultra short-term bonds like less than 2 years, 1 year, or maybe 6 months, 7 years down the line. So this is the major classification, further classification of open-ended schemes relating to debt. Now we have equity. In equity, there are 5 major approaches with which one can invest in the open-ended schemes. One can have sectoral, one can have index, one can have ELSS, one can have small and mid cap, and one can have diversified. So let's talk about each one of them one by one. In sectoral, the mutual companies are going to invest in those particular sectors, maybe in real estate, maybe in food sector, maybe in FMCG, maybe in kind of any investment based portfolios. So that is going to be made on the basis of sectors. It might be a chances that initially real estate is going up, so mutual funds are going to invest in mutual fund. It might be a chances that FMCG is tomorrow going up. Then in such a case, the mutual fund companies are going to invest in FMCG. So that is how sectoral indexes are made. Next come into the picture, index. So mutual fund companies can also directly invest their amount on Nifty or Sensex. These are the broad 2 indices which are available in our country, apart from many which are being state owned. These are the major 2, National Stock Exchange and Bombay Stock Exchange. So the mutual companies can directly invest the pool of funds which are being available by different investors directly into those indexes. So if Nifty goes up, there goes your up mutual funds. And if Sensex goes up, there goes up your mutual fund investment. Apart from that, in order to take care of tax advantage, we can also invest in those schemes which further invest into ELSS. ELSS basically means Equity Linked Savings Schemes. People under the Income Tax Act of Section 80C gets the deduction while investing into ELSS. Government does provide you a kind of appreciation and does encourage you for making investments into Equity Linked Savings Scheme so as to ensure that you start investing regularly, because you might be astonished to know about the fact that just less than 5% people across the nation invest in stock market and these kind of securities. So they want people to get encouraged while investing in these kind of portfolios, in these kind of stocks and these kind of mutual funds. Thereby they provide the tax deduction under Section 80C of Income Tax Act 1860. Apart from that, you can also invest in mid cap or small cap investments. So these kind of mutual fund companies basically invest in those companies that are having their mid kind of capitalization or small kind of capitalization. And the last one, diversified. A diversified mutual fund scheme basically involves all the aspects of sectoral, index, ELSS and mid and small cap simultaneously. They'll be pooling their funds in such a manner that they'll be investing in all 4 of them for that matter. and that is the kind of best advantage for each and every person which is available, that they can invest their mutual fund investment in diversified portfolios. So guys, that was the broad classification of open-ended schemes, which has been like further classified into debt and equity, primarily into 5 major approaches. So now let's move on to our next topic. I guess you got the entire clarity about these kind of schemes in which one can invest, for that matter. That is, I'll be concluding my video with a dose of motivation. Don't be the same, be better. That's a life advice kind of a thing. One has to strive out for daily perfection. Each day you have to result, and certainly try to compare yourself not with any other person in the planet Earth. Just try to compare yourself to yourself as to what you were yesterday and what you are today, and what are you striving for being tomorrow. Guys, don't be the same, be better. This, I'll be winding up this video with a thank you on behalf of Eripedia World. Stay connected guys, and keep interacting with me. Keep asking me your questions, your queries in the comment boxes so that I can help you further with your relative studies, and we'll be covering the entire syllabus pertaining to chapter bond mutual funds in our forthcoming presentations. Till then, stay healthy, stay good. Love you all. Enjoy your day. Bye guys. Take care.